Tom Keene said earlier, perhaps before some of you were here, that while I think we're embracing the enthusiasm, the passion, the energy of our new Canadian Prime Minister, maybe it would be good for him to get off the road and go back to work, because there is some work to be done. Or maybe not. So this is a really interesting time. Growing up, I grew up in the east coast of Canada. I came to from Vancouver to New York in early 2000s, and I think certainly resources have been at the heart of all that I've known in business and living in both Toronto and Vancouver, where the market exchanges were for the longest time dominated by the resource sector. The bloom is off the rose, and so this is an interesting time. It's particularly interesting, I think, because I'm witness here, and now I split my time between New York and London, where the love affair is in full bloom between the U.S. and the U.K. and doesn't seem to be slowing down one iota. And why can't it be better? Why can't there be more M&A activity between the United States and Canada? And I know, Celine, under your guidance, that subject will be explored. I'm going to try and buy you some time, so we have a full hour for this conversation. I'm relatively optimistic we can do that.
Great.
Okay.
Well, thank you very
all.
much. First and foremost, thank you for your patience. We're going to make this worth their while, right? Yeah.
Absolutely. Yeah. Actually, he is.
Yeah. If anything goes wrong, it's Karl's fault. So what we'd like to discuss as we were all preparing and gathering our thoughts is obviously there's a few key things that people have associated with Canada, right? It's the resource sector, what's going on there, what's going on with the currency. There's obviously been some changes around the political landscape. But we really wanted to dive a little deeper than that and talk about, let's talk about middle market M&A. Let's talk about where people can put some money to work. How do you navigate that? So we sort of wanted to deal with that as well, rather than just staying at the sort of 20,000-foot level. And before I dive in, I'd like each of the panelists to introduce themselves briefly. Julian, can you go?
Hi there. Julian Brown. I work for PwC. I've worked for them quite a while now, since 2003. As you can tell from my accent, I'm originally not from here. I joined PwC in Spain, which you probably can't tell from my accent, because I'm English. So, but I was living and working in Spain at the time. I built an investment banking business for PwC in Spain, which brings a few frowns to the audience. PwC is quite big in investment banking globally, in the mid-market, but not really in North America historically. In 2011, I went to Canada. I was based in Toronto, running a business of about 55 investment bankers across Canada. And then in the summer of 2014, I moved here to the US to help us sort of get a little bit better known for investment banking in this market here. So I now work for the broker-dealer, PricewaterhouseCoopers Corporate Finance LLC, which is owned by PwC LLP. And that is our entity that we're currently building strength in the US.
Awesome. My name is Boris Tsimerinov. I'm Principal Investments and Operations with CL Capital. We are a Canadian high net worth family funded private equity firm. We do deals primarily in the Greater Toronto area. We have 4 portfolio companies, 4 control investments. We also manage several minority positions for the same families. I have about 13 years of investment banking, investment financing, consulting experience, primarily with one firm. That's a national Canadian mid-market investment banking firm. About 37 successful M&A financing transactions, plus operations improvement projects. We helped manage a venture capital fund at one point, one of Canada's largest independent venture capital funds called GrowthWorks, when it ran into trouble. So a breadth of different kinds of transaction, investment, consulting experience, and then transitioned to CL about 6 to 9 months ago. It was a very, very, very smooth transition because of the relationship between these wealthy families and the investment bank. So as a result of the transition, I also consult as a director of an entity called Semperate Capital, on transactions, investment activities, operations, projects outside of the scope of work of CL with their knowledge and approval.
Hi everybody, I'm Mark Adkins. I'm a partner with Blake, Cassels and Graydon. We're a Canadian law firm. We have about 600 lawyers in Canada. I practiced in Toronto before moving down to New York in 2003 for 2 years. It's turned into this, and it's been terrific. I'm actually from Winnipeg originally. Wow. Does anyone know where Winnipeg is? And has anybody been to Winnipeg? Well, there we go. So
does anyone know how cold it is in Winnipeg?
That's right. That's right. So
in the summer.
The summer's very nice. But I'm a big Winnipeg Jets fan. I'll happily talk about that too. But really, I came down here and started acting for financial sponsors and strategics on M&A. It's all Americans and some foreign buyers buying Canadian companies. So I do public M&A takeover bids, plans of arrangement. I do private M&A, portfolio companies, asset purchases, generally that kind of work. So for me, it's entirely about translating the Canadian M&A requirements for Americans.
My name is Karl. I'm a senior managing director at Madison Street Capital. We're an investment bank based in Chicago. I'm originally from Toronto. I used to work at Pricewaterhouse as well. I moved from Toronto to Chicago almost 16 years ago. Most of my practice is it's financial services companies, but lately, the last 2 years, there's been an uptick in cross-border deals, especially Canada and U.S. So whether it be M&A sell side, buy side, and certain other distress situations. That's about it.
I'm Celine Armstrong from S&P Global Market Intelligence. Before I joined my current firm, I was an investment banker for 14 years in both London and New York. And when you look at M&A transactions in Canada, they're certainly down year over year, but maybe not as much as other parts of the world. It's still been a relatively robust sort of quarter, all things considered. You obviously have the backdrop of currency devaluation against that, and where the U.S. dollar currently stands versus Canadian dollar today. Can we sort of set the scene from a macro environment as to how you are thinking about this market?
Yes, I think, and I think we had it from the introduction earlier. Canada has always been seen as, a resources market. It's very similar to Australia in so many different ways. I think the other layer that you always need to consider is that Canada has basically compounded its own position in that resource market through the TSX and a number of listed assets that are not even Canadian assets, but that was just a very good capital market for the longest time for assets, particularly in South America, but in quite a variety of places. Mm-hmm. So it really got put on the landscape as a resource-based economy. And I think certainly if you start operating in the middle market and looking at the rest of the economy, the current environment actually throws things into a very different balance. So as the resources market was going through its super cycle, and in particular, obviously, with the oil and the tar sands up in Canada, you actually had a massive sort of shift in interest out from the coast into the sort of Calgary region. Toronto was obviously still the financial centre where a lot of that was happening, but Calgary was really the place where stuff was getting done, or a few hundred miles north of Calgary. But what that left behind was an awful lot of businesses that ended up, because the currency basically appreciated over time, we got to parity while I was there, and beyond, slightly.
Mm-hmm.
Slightly for a short period of time. And what was happening was that it was really pricing out of the market an awful lot of what had been built as an industrial base in southern Ontario, which really struggled badly as the oil prices were bringing the Canadian currency up. I think what we're seeing now is disruptive to everyone because it's happened so quickly. So I think the markets haven't yet fully sort of corrected, and what they're really uncertain about is where does this sort of cycle end, where does it settle out at? But I think everyone is pretty convinced that the Canadian dollar is not going to come back to where it was at parity for a long time, if ever, is the general consensus.
That's right.
And I think that what you'll find is that the competitive advantage that gives you if you're a manufacturer based just across the border from Detroit and so on and so forth is swinging back in favour of the manufacturing base of Canada. And that is where there is an awful lot of mid-sized companies, and the ones that survived at parity are creaming it today. I mean, some of those businesses are doing incredibly well. They also have most of their revenues are US dollar, most of their costs obviously in Canadian dollar. They're very well placed, and I think you're going to see a sort of permanent shifting back into that space, and I think that's going to be very positive for a lot of the non-oil parts of the Canadian landscape. So that's, I don't know if anyone else is seeing similar stuff.
Absolutely concur and agree, and the shift has been happening over a number of years with, in 2012, about 12% of Canada's economic output being contributed from the natural resources. 5 years prior to that, 2007, 2008, 20%. And so that gives you a sense of both the fact of the shift happening away from natural resources to some degree, and secondly, an extremely important, extremely crucial part of the Canadian economy, but that leaves the remaining 88%, which admittedly some of it, as you mentioned also, Julian, are various industries that are services and manufacturing industries that are supporting this sector, however, function differently than the actual base commodities. Yep.
And when you think about subsectors that are of interest, which ones spring to mind that you're aware of? So as people say, well, that's great, so we have some very competitive companies, currency's kind of going in my favor, I should start to think seriously. There's a lack, people often say there's a lack of real mid-market opportunities, there's a lot of money and dry powder chasing it in the US. Okay, so I'm going to start to get serious about Canada. What set of sectors are we talking about?
Well, it's funny you talk about the mid-market, because when I think of mid-market, you think of the U.S., and you're buying private companies, family-owned businesses, portfolio companies, some other funds. But the Canadian M&A environment is fundamentally mid-market. Even our public companies are mid-market. And if you look at we do get those $5 billion deals, but we only get a handful of them. And compared to down here, where it feels like every Monday there's another multi-tens of billion-dollar pharma deal being announced, we don't have that. We have a lot of publicly listed companies on the senior exchange, which is the Toronto Stock Exchange, but also on the junior exchange, the venture exchange, that have market caps of $30, $50, $100 million. And given how easy it is to do a going private transaction in Canada, I see more renewed interest in looking at some public company targets. But in terms of the sector they're in, I've been seeing, again, most of the clients I work with are private equity funds. And they, I know we're not talking about energy, but one thing that's funny is they see distressed assets, we should make money, right? This is a great opportunity. So if they go look at these things and go, wow, I don't know how we make money off this, because things are so poor and the pain is so acute and it could be long term. So they kick the tires and never really do anything. Where we're seeing activity and deals getting done is in manufacturing and also particularly in the auto sector. Auto parts manufacturers, people in the supply chain to the car makers, because I don't know if you know this, but in southern Ontario we have a huge auto industry. And with the lower Canadian dollar, we can build cars cheaply and we can export them to the U.S. So I think that's somewhere there's been a lot of interest. The most interesting investment thesis I heard was that part of what you read about is that we're going to all be driving self-driving, or we're going to be in self-driving cars in whatever, 5, 10, 20 years at some point. I read they're now testing this out in China. They're going to have 100 of these cars in one of their towns. The question is, when they bring self-driving cars to the market, and if that's Apple or that's Google or one of these tech companies that have that the self-driving technology, who's going to build them, and who will they go to build them? And we have a lot of auto parts manufacturers. Magna is one example, but there's others in Canada with an educated workforce, with no cost of healthcare, and with a low dollar that you can pay less money to, and that looks pretty attractive. So I've heard that is at least one of the reasons why you see people looking at the Canadian auto sector and the supply chain there.
Yeah, and that, I think it goes across other industries, like where you have a strong book of business in the U.S. I mean, right now, these companies, like Julian said, they're creaming it because they have these huge revenue contracts with U.S.-based clients where they're getting the dollar in their favor, but their costs are at the Canadian level, where you have you don't have that huge healthcare burden like you would have in the States. And in general, I do a lot of deals with all different sorts of countries. When you do a deal with Canada and the U.S., almost virtually everything is very similar. The legal system is still similar. The accounting system, the accounting
You still need a
principles.
very good Canadian lawyer, though.
I know.
Right? Yeah,
There's some nuances you need to navigate, but
Right.
but it's not like doing a deal in Chile.
Right.
There's a whole sort of different issues that come up. So I think from that perspective, it makes doing a deal a lot easier. Right now.
I think the key to it is the view forward as well. I mean, I don't think anyone should be doing M&A because it just happens to be that it's 67 cents today. I think what you need is for that to consolidate, and I think and look at it going forward. I think today what you've got if you're going in from the US is you've probably got a very attractive pricing on an asset.
Yep.
If that asset is selling most of its stuff into the US, you kind of hedge that through anyway because its EBITDA has gone up by so much because that's already in your pricing. So you're not necessarily benefiting from that. But what you are buying into is a manufacturing cost base that's going to be very different, or a consumer. I mean, there are consumer goods companies up there as well. Auto manufacturing is a really obvious place. And if you look at other places that compete with it, you've got to think that over time, if you've got a reasonable cost Canadian option, it must be more attractive than a Mexican option. Yeah, in terms of education of workforce, in terms of the areas around there. So if you look at how it's shifted in the sort of the sort of supply chain in auto is the obvious one, but auto is just a byword for any other manufacturing business basically. But it tends to be the one that shifts quickest on those global sort of advantages or disadvantages of being in one place or another. And it's a place where at the moment I think you've got higher unemployment, which is a good thing if you're actually looking in there. Your cost of labour is going to be lower than it is in the US. And you've got various other things. You mentioned healthcare, pensions would be another. Most of these things are an awful lot cheaper, and it gives you some competitive advantages up in Canada compared to here.
And I think you're right. I don't think people would necessarily do a deal purely predicated on hoping that the exchange rate stays where it is today. But it certainly does take, the sting out of the price in terms of the price that you're getting in at.
Sure.
And that's obviously something to consider. So as we think about, it's an attractive market. There's obviously various good reasons to take it seriously, particularly when you look at, the activity that seems to go on when a decent asset comes on stream in the U.S. But how do you get into that flow? How do you make sure that you're seeing these assets? How do you even know that they're coming on the block? Or how do you start to navigate that environment? Absolutely, it's a near neighbor, and in many ways will be an easier market to navigate than others. But how would you help people? How have you done it yourselves?
I think a lot of it is the same as you do anywhere else, which is you need to spend time, you need to know the people who are bringing these assets into the marketplace. You need to have some sort of a coverage model, or you need to, you go via someone who basically can produce that for you, so some advisor. But having been, having been on the other side of the border, in mid-market transactions, a lot of which were succession-style deals, I can tell you that they are trying to hire advisors that know their way around the US market, because not just now, but forever, if you wanted to sell a business in Canada, you always wanted to showcase that in front of US buyers. And one of the reasons for that would be that it would be,
do you get multiple expansion?
Unless you were from Quebec. Is that politically incorrect? But yeah, but there was, there was always perceived to be the opportunity of multiple expansion by involving US buyers into that fray. So if you look at any deals that are, in the Canadian market, as you say, mid-market starts quite a bit lower. But if you look at deals in the hundreds of millions of dollars, you would find that a lot of them were actually getting advice. The advisor would unanimously have access to US buyers. There wouldn't be anyone who would hire an advisor who they thought was not going to be able to get into the US market. What that means for a company or a private equity house down here is that they need to plug into the advisor network up there. It's the most efficient way of accessing that deal flow.
Is it necessary to have a footprint and people on the ground, or? I
think it helps. I don't think this is a remote exercise. Especially with the Canadian mentality, I think, at least from our approach, when we're trying to originate new clients, it's not like the U.S. where you can actually call somebody 20 times and never see them and actually get a deal done. Whereas in Canada, I think you actually have to shake people's hands,
Turn up.
meet them. Like like when I think about this year, or going back to 2015, I've gone to like Quebec, Vancouver, BC, and Ontario probably 20 times, and just met these prospects, and let them know kind of what Julian's saying, because you're right. Like they don't care about what Canadians want to pay for them. They want the big American dollar, the big American valuation. And I'm kind of like the translator saying, it's not that much bigger, to be honest. It's like, it's actually going to be pretty much the same what you're going to get in Canada, but you have diversity. You have a broader investor base that, like for a guy like me, that's what I bring to the table.
Yeah.
I can introduce them to different types of PE firms. If it's a lending deal, like specialty finance. Canada is like, I always make fun. I can say this because I'm Canadian. It's like a community of oligopolies. You have like 5 or 6 big banks that decide everything. There's like 3 or 4 big telecoms. There's like, everything's always like these groups of 4 or 5.
Yep.
And they dominate the scene. So if you're doing a debt deal, man, you better have, kiss BMO's ring or CIBC's ring. And that's where I come in and I say, guess what? There's alternatives, There's like 30 banks that can show you in the United States. Yep. And not to mention, Europe or Asia or wherever. So that's kind of, I think, enlightening to Canadian owners, who kind of live in this society where they're just used to, there's only 5 options, and I hope to God I get the best option.
I think there will be an element of, and it depends. A lot of succession businesses, there is still attachment to the business, so there is still concern about what happens after sale. With Canadian businesses, I think it happens everywhere to different degrees, but I think most businesses, and there would be a tendency to try and find as long as my pricing's right, I want the right owner for my business as well. Some of that will be relational driven. Some of it will be just in the prospects of the business going forward, because if that business is kind of tapped out in Canada, they might actually be more interested in listening to a US private equity who can tell them whether they can do it or not, but they can sell the story that they're going to provide more opportunity for the business, scalability into the US market, and so on and so forth. So I think there is almost unanimously an interest in listening. And I will accept parts of Quebec because I think they are different. I think there is, francophone parts of Quebec that are very anti-US, to be honest. They're not friendly to US investors.
Well, I think it's both. I think there's parts of Quebec where
there's both.
They're pro-US and anti-rest of Canada. And then there's ones that are anti-US and they don't really care about other parts of Canada.
And you need to know where each mindset is to be able to play into it properly. So, and not waste your time as well. So, but I do think that there's there would always be an interest in listening to the US investor view. Now, whether that ends up what you need to do, the next question is, how do you adapt your storyline to that opportunity to make you not only appear to be the most attractive on price, but the most attractive owner of the business? And I think for that, you need that cultural linkage that can help smooth over some ripples that might exist.
Yeah, and sorry, it's getting a little off topic, but one point I want to mention was, because as we're talking about Quebec, talking about integration. Because as much as Americans like to think that Canada's the 51st state, and we're just like Vermont or something, there are differences, right? And there are differences depending on where you do your deal. And we had a client based in Pennsylvania that was a manufacturing client, and they had operations in Europe, so they were familiar with doing business overseas. And they bought a manufacturing facility in Quebec, in rural Quebec, in a town called Gatineau. And they announced the transaction, and then the management team went up to Gatineau to go meet with all the unionized francophone workers at this facility. And they weren't that dumb. Like they realized that they would be French, and they realized there'd be cultural differences. So what they did was they hired a consultant to come with them from Paris, who spoke French. And so they got up there with the new American management team and their Parisian consultant to say, welcome, you're now part of our big American family. And there was a revolt. There were union complaints, there was work stoppages, all this, and the general counsel of the client afterwards said, I never realized that the Quebec French hate the French. Right?
More than they hate the other people.
More than they hate anybody, right? So that was a real learning experience, and I wish we'd known they were going to do that, because that's something our partners in Montreal could
You might have stopped them.
could have helped them with. So,
And that's where, to Mark's point and Julian's and Karl's point earlier on, the communication and what it is that you're presenting as far as your brand, as far as your experience, as far as how you're going to be as a deal partner, whether a deal partner just for the transaction process or a deal partner as a potential equity partner together in the business if the management or the owners are still maintaining a stake. I think that's crucial, and that's where having someone on the ground, whether it's advisors and lawyers or bankers who have done work or folks that have offices across Canada and the U.S., or actually putting people on the ground and establishing an office, say for a private equity firm. Julian and I earlier, right before this panel, were discussing someone we both know in common from Winchurch Capital as an example, who have established a beachhead in Canada, say in 2008, and have done extremely well, extremely connected, extremely networked, have done, let's say, 4 or 5 deals now in Canada, probably either more than anyone or at the upper end in terms of the number of deals that people have done in the mid-market, because the gentleman who's representing them there, Morty White, who's a managing director with Winchurch, he has integrated himself into the Toronto community and financial markets so well and so smoothly. When people are interacting with him, they see the strength and might of the private equity firm based out of Chicago, same as they would see with PwC or they would see with Blake's, a Canadian firm, and having folks in the U.S. And Karl, with you folks with Madison doing international transactions, they see both the prestige and reputation and X number of billion in funds under management, but they also see a person on the ground who has the same relationships as they do, whose reputation they can double check. They see their own businesses in Canada speaking the same language beyond just English, beyond pronunciation, but subtle differences about being sometimes less aggressive, more cordial, more collaborative, et cetera, I think makes a big difference in whatever shape or form you do it. I think helps quite a bit in actually not only being a good partner subsequently, but getting a deal done, where I have seen U.S. acquirers, I have seen U.S. buyers being dismissed for the wrong approach or for people not being able to check them out properly.
Yeah, no, I think that's very true. It's just knowing knowing your audience, knowing the way to make it culturally. I remember advising quite a few private equity houses, particularly out of London, who have been trying to do deals in Spain forever, and I said, you will not do a deal until you put an office in Madrid. I don't think you're at that stage with Canada. I think the cultural bridge is a lot shorter than that, but you're absolutely right. You're going to be more effective if you kind of make the commitment and go a little bit further. Yeah,
and a long-term relationship in whichever way.
Yep. But it's not impossible to do deals from outside, I think, whereas it would be in places like, you can't fly in from London and do a deal in Spain. You can't fly in from anywhere and do a deal in Paris. But there are certain countries where you just cannot do it unless you're on the ground, unless you're local.
But I was going to say, it's easier now. Like 5 years ago in Canada, we tried to we were thinking about opening up an office in Toronto. It was hard because everyone was so resource driven, and they were like, "Well, what are you going to be doing? Like, what type of investment banking? M&A, like sell side M&A,
diversified,
middle market, like companies that don't do resources, and they're like, you're nuts. Like, unless you have something that's related to oil and gas, minerals, metals." And I'm like, we're not selling product here. We're not trying to do IPOs for the next mine. We're trying to help the guy that came up with an idea to make an app that's going to make $50 million next year. We're trying to help that guy. But we got a lot of pushback. But now I think it's a different story.
I think that's very true for advisors. I think for investors it's a little bit different. So I think that where you've got the investment community in the US, if they do have an interest there, their easiest way in is to, and I think it's just not on the radar for a lot of people. We've had a lot of discussions with even large cap private equities here, and they're looking at their portfolio companies and how they can grow them, and they're going through all sorts of, and I said, well, have you thought about this company up in Canada? And I said, we never looked in Canada.
Right, it's not on the radar.
And there's some really obvious things that once you've been in both markets, you can say, well, hang on a minute. So I do think it's kind of off radar, very strangely from my perspective, because it's kind of right there.
Well, and even the funnier part, too, is like you have some bigger middle market companies that they're too small for Canadian pensions. Like you show a deal with Canadian pension, they'll be like, unless it's making $500 million revenue, like we really don't want to look at this. I'm like, it's based in Toronto. Like, are you crazy?
Well, but the thing there is, so there's, and I think this is an important other point that you've raised, because the Canadian pension funds, if you look at their global asset allocation, they can't make...
They're too big.
They can't make many more deals in Canada. They're already way Canadian heavy.
Mm-hmm. Right, from
if
a
you look at their overall
risk.
balance of portfolio. So if you talk to CPPIB or you talk to teachers, they say, look, even if something comes up in my back, that's not the deal for me. I'm much more interested in buying Neiman Marcus or buying into some deals in the US and diversifying my global, because I am now a global investor with 30 to 35% of my assets in Canada. What the hell's that about? It really is.
Well, it's also a size element. Like you need to move the needle.
Yeah.
It has to be in the hundreds of millions or even billions.
Yeah, it's a bigger deal area, but they're not looking. Even at that level, they're not looking in Canada. So I think there is an open market there in terms of, at the bigger end, the local guys are not really focused on it. The mid-market, that's different. And there's high net worth individual funds like your own. There's several sort of listed funds. There's some funds around in the mid-market. But if you were to look at mid-market deal flow versus number of funds chasing them, you might well find that your odds are better there than they are here, which is a rather strange. There's a huge market here, but there's a hell of a lot of money chasing it as well.
And one of the reasons is exactly what you gentlemen have mentioned, is the pension funds writing bigger checks, taking some money away from the middle market funds, not committing to them as LPs, taking it elsewhere for the reasons of allocation and for the reason of reputational risk, not wanting to squeeze out average Joe investors.
Carlyle than a Canadian PE firm.
One other distinction among because people talk about the Canadian pension funds and we tend to lump them together. Right. But you have to understand that these are actually often quite different investors. And a fund like CPP or Ontario Teachers will do a direct control investment and buy a portfolio company. A fund like BCIMC, which is the British Columbia Fund, really doesn't do that. They have very different investment concepts. And they also have a different basis for investment. So someone like AIMCO or Teachers will invest for pure return. Funds in Quebec, like the Caisse de dépôt or PSP, have a mandate from the provincial government that they have to also consider the well-being of the province in their investment. So it's something to keep in mind if you're looking at either you're bidding against a pension fund on a potential acquisition or buying something from them or selling to them. Not all funds are created equal, and they just have different priorities.
No, you're right.
And once you've identified an asset that you're interested in, and things are moving along quite well, what about capital markets access? How are you going to fund it? And what's the dynamic there about doing it in Canada versus getting funds elsewhere? How different is that? I imagine rather different.
Well, I think again it goes back to this concentration issue where on the debt side, you know who to go to, in terms of the banks. There's going to be that 5 or 6 big banks, and then they say more because there's some bigger Quebec banks as well. Versus America, USA, where there's hundreds of banks. Like, in order to get a deal, like we can show a deal to at least 100 banks. So that's, I think you're limited in Canada in that respect.
Although there were impediments to having a foreign bank, like a U.S. bank, be the lender on an acquisition. But that were repealed. So now there theoretically is no reason why, if you're an American buyer, you can't go to your normal American bank and have them finance your acquisition.
In the Canadian branch.
Or even directly. You can go directly to Wells Fargo out of the U.S. and have them finance your acquisition. You can certainly do that. But
it's not easy though. Like they're still fundamentally, I think they say they can do it, but when push comes to shove, they come up with excuses about jurisdiction and how we're going to monitor the asset if it's all in Canada. But I know what you're saying. So we're showing a deal right now. PNC Canada is going to be doing the financing, but I don't think it was done through. If it was done through PNC US, I don't think they would have done it.
Right. Well, and the other thing that I noticed, because the debt market sort of froze up in the U.S. towards the end of last year, that's been a real impediment in a couple of deals, but on one that should have closed months ago. But still, they're looking at financing options. And what they did was, it's a Canadian target that existing Canadian lender, the incumbent lender, They ended up going to that Canadian lender, never worked with them before. This is a private equity buyer, and got very good terms from one of the big 5 banks. And then because they're a private equity fund, they went and shopped that, right? And then they ended up finding a different Canadian lender, another large bank, got even better terms. And so they've forgone their usual sources and are going to like a purely Canadian bank. So that's one nice thing. Debt financing is obviously part of your acquisition. Then the fact that we haven't had that sort of tightening up of the credit markets is helpful.
Yeah. And I think that in itself has been the pendulum swing. Yeah, the reason that they've tightened up here is because of the excesses. The Canadian banks were never allowed by the regulator to get into such excesses, so now they look smart. Whereas they were just more conservative right the way through, probably to a grand extent because of the regulator rather than themselves. But now they're the guys who still have balance sheets that are relatively intact. We'll see what the flush out from the oil sands are, but which is starting to dig in now. But I don't think there's anyone too concerned about the actual stability of the banks, and I think they are still more in the markets definitely than they are in the US. I think the difference is that that's your only source. You don't have a bond market. So if you look to anything in the US now, then banking has become a little bit irrelevant as soon as your deals get over a sort of 400-500 million level, because no one's financing it through the banking system. They're all going to the bond market. That's not an option up in Canada unless you can access the US bond market for a Canadian acquisition, which theoretically you can. I just don't know if it's being used a lot.
No, not at all. And then certainly on Mark's point, there used to be withholding taxes up to 25% for foreign lenders, but now with the treaty exemptions, you can easily go around that. And then to Karl's point in terms of the differences between the Canadian lenders and U.S. lenders, in my mind, I have a distinction between Canadian-based, Canadian-grown chartered, as they call Charter 1 banks, and certainly the big 5, big 6 banks that we've talked about, then the Canadian subsidiaries of U.S. banks, which are then Charter 2, and then you have U.S. financial institutions operating out of the U.S. and having the potential, now that there's exemptions for the withholding taxes, to lend into Canada. And I think there's then gradation of distinctions where Charter 1 banks have been in Canada for over 100+ years for the big 5, 6 banks, being CRBC, RBC, Scotia, TD, BMO, National, the big 6, and so they have huge retail networks. As a result of those retail networks, they're able to do cash management very cheaply, and they're able to offer more solutions and more products.
Yeah, it's a diversified relationship that they have, right?
Yeah, to a particular borrower. And so there's greater demand for their services. They're able to offer their services more cheaply. Number one, that the Charter 2 banks that are U.S. subsidiaries, Canadian subsidiaries of U.S. banks, they're simply not able to offer. And then secondly, because of having their capital base in the U.S., having to transfer it into Canada, rely on that other infrastructure, their cost of capital is greater. So they're less competitive in Canada unless they're using innovative products, such as U.S.'s very strong, very developed ABL markets and very interesting structuring options that they do bring into the Canadian market. But if you're talking about basic cash flow lending, then it's the big 6 that are leading, both structurally and relationally.
And they're hard to beat on rates. Like right
Exactly.
now, like they're extremely competitive.
Yeah. The other factor to strongly consider in the Canadian leverage market is just simply the conservatism that Julian has mentioned of the Canadian banks, where they simply won't lend the same leverage multiples for the same size deal, let's say 30 million in EBITDA. I actually don't know what the latest is on the U.S. market, but in Canada, if you are the top tier private equity firm, you might get 3.75, 4 times debt to EBITDA, maybe. If you're not the top tier for this size of a transaction, which to begin with, as Mark mentioned, is probably the upper end of the mid-market, then you're not getting beyond 3.25. Versus my perception is in the U.S., it's quite a lot more for plain senior financing.
Are there any regulatory concerns that differ versus the US? Anything, Mark, that sort of pops out to you as being very different in these markets?
The one key difference is your structuring, your tax structuring. You want to be able to acquire the company in the most efficient way. You want to be able to repatriate your cash during the term of the investment and then have an efficient exit. And that is something that's becoming a more well-trod road and something we do all the time. But that's something to keep in mind is what are the tax implications. We do have antitrust laws just like in the U.S. Our HSR is called the Competition Act. The procedure is very similar. The thresholds are very similar. None of that is really not manageable. The one thing that people get concerned about because it makes headlines is we have foreign investment legislation called the Investment Canada Act, which governs acquisitions of Canadian companies by foreigners. But in the middle market, this is virtually never an issue. Our thresholds now are at $600 million. So any mid-market deal is going to usually fall below that. The one exception being, and this can trip people up, and it does, is unless there's some cultural component to your transaction. We tend to think that Canadian culture is unique. We want to protect it. We think that Justin Bieber and Celine Dion are national treasures, and we want to promote more of that. That's that. We send them to the U.S. So Mike Myers, right? John Candy. So if you have an acquisition and any portion of it's cultural, and that can be like a magazine you publish, or videos on your products, or anything to do with film or television or broadcasting, in those cases, the threshold for review falls all the way down to $5 million. So you can easily be caught. And sometimes you buy something that has nothing to do with culture. We recently worked on a deal for an American buyer that bought a ski hill. And the ski hill wasn't cultural, but on the ski hill was a store. And the store sold videos of snowboarders and magazines and books and everything. And, it's fine because we knew about it in advance. And what we did was we hived it off. We sold to a third party, did a lease back so they could keep the store, but wasn't part of the business. Because otherwise, that's cultural. It would have triggered it. And it seems completely illogical, but that's the way these rules work. So if you know about it up front, all this is very manageable.
So the answer is hire a good lawyer to keep you out of trouble before you get into it. Right?
That's very good advice. I agree with that. Yeah.
I was saying another scenario that we talked about before was if you have government contracts. So like we have a client that does extensive work for the government, and we were trying to sell them to a U.S. private equity firm, and we had to consult with Blake's on how we would structure it because there was this transfer of ownership issues, and basically the government doesn't want a U.S. owned company providing security services for them. So that's another. But I think that's not specific to Canada. I think that could be to any country where you're doing work for the government.
Well, that's it went the other way just yesterday, right? Because CP Rail was bidding for Norfolk, right? Mm-hmm. And then all the local states were fighting against it because they transport military equipment and saying this should be, they just didn't like the deal, but they were fighting it on that basis. So absolutely, it goes both ways.
Right.
I wanted to be mindful of time and ask if anybody has any questions for our panel.
If there's tremendous room for growth between Canada and U.S. M&A activity, I mean, how can we bridge the missing link, both from the Canadian as well as the American state?
Well, I think that on the Canadians are actually a net acquirer of U.S. companies. That tends to go back and forth a little bit, but the last few years, Canadians have bought more of the United States than you guys have bought of us. And especially real estate. I mean, Brookfield's the biggest commercial landlord in Manhattan now. I mean, you see their buildings everywhere. So certainly the Canadians know the American market well. On the U.S. going into Canada, I really think that it's, the dollar has been an impediment, and the focus on resources has been an impediment. Now that those have both gone away, I think it's just going up and kicking the tires and spending time there.
Yeah, I think it's momentum.
Right.
I think we'll see a few more transactions in 2016, and that'll start, I think, probably kickstart more activity.
I think there's a question of focus as well. I think a lot of US companies are very focused on what's going to make a difference strategically, certainly the larger guys. They're looking more about, what are the very large growth markets going forward. So there's a lot of attention paid on places where, to be honest, it's been quite difficult to do deals. So China, India, some of the sort of countries that if you're not in fairly soon, then by the time 2030 comes, you don't exist. And I think there's been a lot of focus at the top of corporate America on those places. It's very easy to overlook Canada because Canada is like
the obvious.
It's 10% my market size in the US. Should I really be spending time on it? And I think where you'll find people getting a little bit more engaged is there's a payoff between what the opportunity is and how easy it is to access. And we've seen this more recently with the love affair between New York and London. A lot of that is because in a zero growth environment where it's proving very, very hard to actually make a success out of stuff in a lot of emerging markets, whether it be India because you can't own more than 49% of a company, or in China because it's just very, very difficult to know how to go about doing business in that country and owning assets in that country. What's happening is those corporates are saying, hey, how can I do easier, larger, bolt-on deals that make it look like I'm growing my business? And you've seen a big pendulum swing back into mature markets, acquiring in mature markets. And I think that will run its flow, and there should be an amount of attention put on Canada. I think at the moment it's just because it's kind of small. Is it really going to move the needle back at head office,
Any other questions?
You seeing any kind of significant activity in the distribution sector? Any kind of deal activity going on?
It's distribution, just generally, or logistics, or yeah. So these guys are probably a little bit closer to it than I am. I don't think there's, to my knowledge, there's not been any. Sort of groundswell where you can see there's a trend coming that distribution networks tend to be, obviously if they're national in Canada, they're going across this way. So what you tend to have is consolidation on each of the east and west coast, and not really a lot happening in the middle. Now, whether those should be combining with east coast US and west coast US, there's probably some efficiencies. It's not a sector I know particularly well. I know enough to be dangerous, but nothing more.
I mean, for us, we're seeing it. So logistics, like trucking logistics, we're seeing Ontario to southeast U.S. That's a big connection. So we're representing a company right now that's looking to buy a company based in Virginia that's got routes from, like, say, northeast U.S. down to Florida, and they want to bridge what our company does, which is basically Ontario to East Coast U.S. and Quebec. So that would be a long, big path. But even Quebec, so we're working with another company, it's different type of logistics, but they want to expand into U.S. big time. So, like, kind of your point is this whole argument about there's the weak U.S. dollar, or strong U.S. dollar, weak Canadian dollar. There should be U.S. companies buying Canadian, but actually, if you have a scalable platform and a big opportunity to grow a U.S. market, Canada actually, they're looking at U.S. For a lot of different opportunities.
Well, I think Canada, what it's really latched onto is that the U.S. consumer looks like a much more attractive marketplace than the Canadian consumer marketplace. If you roll forward over the next 5 years as to what you see in consumer expense and spending and all that sort of stuff. So I think what you're seeing, and for Canadian businesses, that's kind of live or die, whereas for the U.S. guys, it's, maybe there's another 10% here. That's, I think, what's driving an awful lot of the reverse interest, if you like, because they're saying, this is more about survival than anything else, and getting into the U.S. consumer base. But if you look at all those businesses that are doing that, you've seen it around building products, you've seen it around manufacturing, you've seen
engineering services.
Everyone looking to get into the U.S. consumer market from Canada for the last
retail is trying, but
retail is trying. Mm-hmm. So there's a lot. There's a lot of interest in gaining access to the U.S. consumer.
Mm-hmm. And we had a bid a few months ago for a food trucking company based out of the Western Canada. It was sort of BC, Alberta, Saskatchewan, Manitoba. It was not in the east, and we weren't the successful bidder. I think there's a lot of interest in the asset. But the one thing is, if you're not looking east-west, you're looking north-south.
Yeah.
Problem's the border, right? And again, I'm a Canadian, so I'm just watching this from afar. But you've got all kinds of politicians like building walls. So I don't know if we're going to have a wall. I don't think we're getting a wall across the Canadian border, right? But apparently the Canadians, right? But it's, and obviously, I'm being facetious. I mean, there's lots written about this in the Globe and Mail about what it would look like if we built a wall. But even if it's not the wall itself, but just the having the transparency of the border, being able to get trucks through, inspections. There's U.S. concerns about national security. about server protection is Buy American platform. Any of those things can happen. And if you're in a north-south business, you have to have a good sense of where you think that's going.
It's an added cost of doing business.
Also, your question rings a bell in the context of distributors, i.e. wholesale distributors, businesses acquiring product, distributing over the network, and that's where the exchange rate is going to play a huge difference. If they're buying in US dollars, then they're struggling. Then either they're struggling and they're not going to survive, or there might be an acquisition opportunity.
Okay. Could anyone predict the, I guess, likely legacy of Justin Trudeau?
My mom can. She loves that guy.
So vote for Mark's mom.
One quick question. We're working with Chinese buyers, really interested in the Canadian opportunities. So can you talk about the M&A advisory, scene there? In the U.S., we can work with, middle market advisors, Raymond James, Greenhill, a lot of them. What about the advisory, landscape in Canada for the middle market deals?
Yeah. Yeah, I mean, there's a advisory body of people up there. There are, as I say, all of the main banks have an advisory branch. There are then all of the Big Four accountancy firms have an advisory branch. And then there are a fair few independent boutique advisors running they tend to be a little bit more either East or West Coast or based in the tar sands themselves. There are some advisory shops based out of Calgary. We spent a lot of time, I personally spent a lot of time going to and from Toronto to Beijing, purely because as the capital markets for resources apart from oil, so minerals apart from oil, dried up an awful lot before the oil price change came upon us all. And we were in pretty much a dead sort of capital markets situation from about 2012 to 2013. Whereas before the TSX had been a great place to raise capital and so on and so forth, it really struggled from about that point in time. And what we saw was an opportunity for people like ourselves to take over from, there's some good boutiques up there, Canaccord is very well established, they're having trouble, but they were so resource-based that we saw it as an opportunity, so resource-based but shopping resource deals to the Canadian capital markets, that's what they did. And they didn't have the connectivity that someone like us could give them over in Beijing, over in the Japanese trading houses. And what we were trying to do was to step into what we saw was, these guys are going to come in and have direct investments. They're still interested in the minerals and so on and so forth. We found it very difficult to match those two things. And that's with a foot in each, business at each end of it. And part of that is just, the bridging that cultural gap. And I think, certainly from China, the initial focus was very much Australia. And Australia had an awful lot of good resource, possibly better suited to its needs in terms of actual mineral resource than a lot of what was available in Canada. And they also had the advantage of being a hell of a lot closer when it came to, time zones and transport and so on and so forth. So, I think that will come back. I mean, China is, as you know, has a very different planning process to anyone else. I think while it's cold at the moment, there will be that need kicking back in over time. And I think now is the downtime when you can actually start building all those relationships that are necessary for the deals to happen in a few years' time. Because that's what we found. You can't go to China and sell a deal today. You need to have built that relationship over quite a while beforehand.
I think we had one last question, the gentleman down the back.
Make an observation, but to respond to the woman's question earlier about the gap, activity gap between the U.S. and Canada.
Yep.
As a recovering Canadian banker and a practicing M&A guy, and a dual citizen, by the way.
Nice.
I was at RBC for a long time. And to answer the Chinese gentleman's question, I think a lot of what we've observed RBC doing is coming to the U.S. market to take advantage of the differential in the fee pool.
Yes.
And trying to go up market from a banking services standpoint at the same time.
Yes.
What that's left is a gap in middle market M&A provision in Canada. And I would maybe even observe they'd be happy to take your call in the United States and refer you to all their colleagues in Canada. So I think they're backfilling in terms of advisory capability across the big banks from the U.S. standpoint back to Canada. But I think one of the observations I would make is from a sophistication standpoint, a lot of U.S. acquirers go to the emerging markets because they can advise their client, the acquisitive client, that there's inefficiency in sophistication, that there may be an inefficient process, there may be an inefficient manufacturing knowledge, management capability, and so there would be a better deal, a better value.
There's a value add post deal.
It's a problem of sophistication. I think that our Canadian brethren are very good businessmen. There's a very robust financial capability in Canada, across Canada. There's no language barriers. There's no really economic inefficiency. So it's not as obvious an opportunity in many cases. And I think that's a barrier to entry. I think where there's a good deal, inefficient deal in Canada, the best buyer of that deal is a Canadian company. Because there's a lot of inter-Canada deals. But I think from a sophisticated acquisition standpoint, that might be a barrier to entry, essentially, for a U.S. acquirer. Just an observation. I wonder what your thoughts are on that.
Interesting observations. From one of the data sets I've seen for trailing 12-month deal activity, cross-border transactions were around, let's say, 40%. And that's all cross-border transactions, which confirms the point that you're making, that certainly a lot of the deal activity is within Canada. Absolutely agree on your points regarding the Canadian advisors and Canadian banks and their shift in focus. The point that rings important to me is one that Mark made earlier regarding the mid-market and what is mid-market. What are we talking about? What size range? Where depending on the gradation of that mid-market in Canada, you could have decent access through Canadian banks and their bank-owned dealers. You could have outstanding access through the accounting firms. Once you go down to a certain size range, my perception, and please correct me if I'm wrong, is that for the accounting firms, the access diminishes to their assurance audit base for certain size, where there's a little bit less reach out to clients that are outside the existing network. And that's where, depending on the exact geography that you're in, then you need to seek independent advisors, whether it's in the form of folks coming in from the US or advisors as in lawyers, because there are a number of counsels and there are a number of law firms that are very good transactionally and very good at executing the transactions from a legal perspective. In addition to that, are also very thoughtful about business development and keeping relationships with businesses that might transact later on and might provide opportunities for deal work. So I think for me, responding to both your points, it depends really on the size of the transaction that you're seeking.
And industry.
And industry,
make
yes,
no
of course.
mistake, if you're a Chinese investor and you want to do a resource deal, you're going to have 10 boutique banks in Canada that are global best because they know that industry. And also, one thing I love about Canada is it's not provincial, meaning like in the United States, a technology deal, it's usually on the coast. It's usually West Coast, Silicon Valley, or on the East Coast, New York or Boston. Whereas Canada, there's stories in Ontario, there's technology hubs in Quebec, in British Columbia, the Maritimes. You got to know the lay of the land. And I think that's what makes the people who are more, I guess, true middle market investment banking advisory, that's their strength. Is the fact those that know the lay of the land and know where the opportunities are geographically.
I think there's a problem about sustainability, like no-tail networks. What's going on with BlackBerry now?
I know it's tough.
It hurts. Whenever you read, I live in Canada. When I was when I lived there, I became Canadian as well. So, you know, whenever I read it, something like that, it does hurt.
And I think that's a problem of a company in a small, economically speaking country.
Right.
So you could say the same about Nokia in Finland. You could say, I mean, they attract a sort of, you know, a massive disproportion of bad news into there. And you know, BlackBerry's the obvious more recent one, and a business that was right at the top of the game and then got overtaken by technology. I think the difference is in the US, it's more likely that, you know, Apple gets taken over,
Right.
you know, overtaken by, you know, something outside of Apple, and Apple doesn't kill the US economy. BlackBerry killed the local economy in that part of Ontario. And you know, I think that's just the relative impact of having a global company based in a small country.